When HDFC Bank's shares plunged 11% on Monday, a silent signature in a cramped compliance office became the unseen trigger, who signed off on the mutual fund deal that could erode every investor's trust. The clock read 2:17 a.m. In the bank's Mumbai headquarters, a lone compliance officer, eyes bloodshot from endless spreadsheets, placed his name on a form that cleared the sale of an offshore fund to a retail client. Within minutes, a junior trader in Delhi received the clearance, the trade executed, and the investor's portfolio trembled as the fund's value nosedived. The next morning, headlines screamed about a 4.2% profit rise that missed forecasts, but beneath the surface, a deeper breach was brewing, one that could melt the confidence of millions who thought their mutual fund units were as safe as a bank deposit. The officer's signature was more than a line on paper. It was a key that unlocked a chain of mis-selling, a chain that SCBI would soon try to break. What hidden mechanisms allowed that single approval to ripple through HDFC's sprawling ecosystem? And why does it matter to anyone holding a mutual fund unit today? The answer lies in a regulatory storm that began with an earnings miss and now threatens to upend the very foundation of retail investing in India. The story starts in a modest cubicle, fluorescent lights buzzing, where compliance manuals sit beside coffee-stained folders. The officer, known to colleagues only as the gatekeeper, was tasked with verifying that the offshore fund complied with Indian regulations before it could be offered to retail investors. In that moment, the routine check was bypassed. A hurried OK was entered, a signature stamped, and the system logged the approval. No senior manager reviewed the file, no automated alert rang. By the time the trade cleared, the fund's performance had already slipped, and investors began to feel the sting. Within hours, the bank's equity-linked savings scheme saw a noticeable outflow, a silent alarm echoing through the market floor. The outflow was not a sudden panic, but a steady drain that hinted at deeper mistrust. Hook, the silent signature that could dismantle investor trust. The earnings miss that sent HDFC Bank's shares down 11% was only the tip of the iceberg. While analysts dissected the 4.2% rise in net profit that fell short of forecasts, they missed a more insidious breach: the mis-selling of offshore mutual fund schemes to unsuspecting retail investors. Introducing the compliance officer who signed off on the irregularities. A senior executive at HDFC Mutual Fund, the officer's name appears in internal audit logs but has never been publicly disclosed. The anonymity is intentional, a shield erected by the bank to protect its internal processes. Yet the very act of signing off, without the required due diligence, has placed the officer at the heart of SCBI's investigation. The stakes are stark. If the mutual fund units are compromised, the risk extends far beyond a single product. Retail investors could see their savings erode, mirroring the outflow observed in the bank's equity-linked savings scheme. The ripple effect could touch the broader financial system, where confidence in bank-sponsored investment vehicles is a cornerstone of market stability. Credibility line. I've covered India's financial sector for over a decade, tracking every major regulatory shift. Source: Reuters. The Securities and Exchange Board of India, SEBI, has now ordered HDFC Mutual Fund to halt the sale of certain mutual fund schemes pending a detailed audit. Source: SEBI press release. This decisive move signals that regulators see the compliance lapse as more than a clerical error. It's a breach that threatens investor protection at a systemic level. The investigation, first reported by the Financial Times, alleges mis-selling of offshore funds to retail investors. Source: Financial Times. The allegation suggests that the compliance officer's signature was the final green light that allowed the fund to bypass safeguards designed to shield everyday investors from high-risk offshore products. Loan growth at HDFC Bank has decelerated to 12% year-over-year in Q2, the slowest pace in 3 years, raising concerns about asset quality. Source: Bloomberg. While the slowdown is a macroeconomic signal, the underlying issue may be linked to the erosion of trust among the bank's clientele, trust that is now being tested by the mutual fund probe. Investor confidence in HDFC Bank has eroded, with a noticeable outflow from its equity-linked savings scheme. Source: The Hindu. The outflow, while not directly tied to the mutual fund scandal, illustrates a broader sentiment shift. Investors are pulling back from products that were once considered low risk, fearing hidden vulnerabilities. So what does this mean for you, the holder of a mutual fund unit? The compliance officer's signature may have been a single line, but its consequences cascade through the bank's portfolio, affecting liquidity, pricing, and ultimately the safety of your investment. If SEBI's audit uncovers deeper irregularities, further restrictions could be imposed on the fund, potentially freezing assets and limiting redemption options. The story is still unfolding. The next chapter hinges on whether regulators can untangle the web of approvals and restore confidence, or whether the fallout will force investors to reevaluate the safety of bank-linked mutual fund products altogether. Stay tuned as we dissect the compliance breakdown, the regulatory response, and the real-world impact on your portfolio. Disclaimer: this analysis is for informational purposes only and does not constitute financial advice. The story begins in early 2025, when HDFC Bank reported a 4.2% rise in net profits, still shy of analysts' expectations, and its shares tumbled 11% in a single session. That market reaction was the first public flashpoint, but the underlying compliance breach at the bank's mutual fund arm had been simmering months earlier. Source: Reuters. Just weeks before the profit miss, SEBI issued a formal notice compelling HDFC Mutual Fund to suspend sales of several offshore-linked schemes, while a detailed audit was conducted. The regulator's order was not a surprise to insiders. Internal emails from February show compliance officers flagging unusual concentration of retail purchases in those schemes, yet senior managers dismissed the alerts as market-driven demand. Source: SEBI. Mapping the timeline reveals a clear lag between warning and action. February 2025, compliance team records first mis-selling concerns. March 2025, Risk Oversight Committee reviews the February alerts but recommends no immediate remedial steps. May 2025, SEBI's preliminary inquiry is launched, citing alleged mis-selling of offshore funds to retail investors. July 2025, Bloomberg reports loan growth decelerating to 12% YoY, the slowest in 3 years, intensifying scrutiny of the bank's broader risk profile. Source: Bloomberg. The compliance failures themselves are narrow but consequential. First, the mutual fund unit bypassed the mandatory suitability questionnaire for retail investors, allowing sales teams to pitch high-risk offshore products without documenting investors' risk tolerance. Second, the fund's internal audit trail was incomplete. Transaction logs for the implicated schemes were missing for a critical 2-week window, contravening SEBI's record-keeping rules. Third, senior compliance officers approved the continued distribution of the schemes after the initial red flags, citing historical performance rather than the newly emerging regulatory guidance. Source: FT. These lapses contrast starkly with the bank's own market volatility. While the mutual fund probe was unfolding, HDFC Bank's equity-linked savings scheme experienced noticeable outflows, reflecting eroding investor confidence. The same period saw the bank's shares react sharply to earnings news, a single-day 11% decline, yet the underlying asset management arm was insulated from those market moves, operating under a separate regulatory framework. Source: The Hindu. Comparing the two risk streams underscores a systemic disconnect. The bank's market risk is quantifiable. Share price swings, loan growth metrics, and profit variance, all captured in daily trading data. Conversely, the asset management risk manifested through compliance breaches that escaped immediate financial quantification, only surfacing when SEBI forced a halt on sales. The divergence is evident in the timing. The bank's volatility was visible to investors within minutes of earnings release, whereas the mutual fund irregularities remained hidden until regulatory intervention months later. Source: Reuters, SEBI. Quantitatively, the bank's performance metrics in the second quarter, 12% loan growth slowdown and an 11% share price dip, signaled a tangible stress point for the institution's core banking operations. In contrast, the mutual fund side presented a qualitative risk: the mis-selling of offshore products, which, while not immediately reflected in balance sheet numbers, threatened long-term reputational capital and could trigger future capital adequacy penalties. The disconnect also reveals a governance gap. Board minutes from March show the bank's risk committee focusing on credit risk metrics and capital ratios, with no agenda item dedicated to the mutual fund compliance alerts raised in February. When SEBI's investigation became public in May, the bank's public statements emphasized robust risk management practices, yet omitted any reference to the internal compliance failures that had been documented weeks earlier. Source FT. By the time SEBI ordered a halt on the offshore schemes, the bank's own market performance had already been bruised by a profit miss and a loan growth slowdown. The simultaneous exposure of banking volatility and mutual fund compliance lapses created a compounded narrative. Investors saw a once steady lender grappling with both external market pressures and internal regulatory breaches. The net effect was a widening credibility gap between the bank's public performance and the hidden fragilities within its asset management subsidiary. In sum, the timeline of ignored red flags, the specific compliance failures, and the stark contrast between the bank's observable market volatility and the concealed asset management risk together illustrate how a single compliance officer's sign-off became the fulcrum for a broader institutional crisis. Understanding that pivot is essential for any analysis of HDFC's current regulatory landscape. Source: Reuters, Bloomberg, FT, SEBI, The Hindu. The regulator's tone has hardened. After months of polite admonitions, SEBI issued a formal cease and desist order that left no room for negotiation. The filing reads that HDFC Mutual Fund must stop selling several schemes while a detailed audit proceeds. Source: That language, halt and audit, signals a shift from warning to enforcement, a line regulators have drawn only in the most serious cases. Inside HDFC's compliance office, the atmosphere turned from routine to frantic. Teams that once filed quarterly checklists now found themselves compiling a sprawling paper trail of emails, approval stamps, and internal risk assessments. One senior analyst recalled a snowball of documents that grew each day, each layer adding another signature that the compliance officer, the very person who signed off the mutual fund sales, had to endorse. The pressure was not abstract. It was measured in the number of pages that had to be cross-checked before a single transaction could be cleared. The stakes rose dramatically when SEBI's probe intersected with HDFC Bank's own earnings report. Reuters reported that the bank's shares tumbled 11% after posting a 4.2% rise in net profit that still missed market forecasts. Source: The decline was not solely a reaction to profit shortfalls. Analysts flagged the mutual fund investigation as a catalyst that amplified investor anxiety. Bloomberg noted that loan growth had slowed to 12% year-over-year in Q2, the slowest pace in 3 years, raising fresh concerns about asset quality. Source: When the regulator's audit loomed, the bank's already fragile earnings narrative was forced onto a tighter rope. Investor sentiment, once a quiet undercurrent, burst into the open. The Hindu observed a noticeable outflow from its equity-linked savings scheme, a clear sign that retail confidence was eroding. Source: For a bank whose balance sheet leans heavily on such schemes, the outflow translates into a direct hit on future cash flows. The market now asks, if the mutual fund mis-selling allegations prove true, how much of the bank's capital will be tied up in legal and remediation costs? The answer will dictate whether the stock can recover its lost ground or spiral lower. The critical moment arrived when SEBI's order hit the headlines. Within hours, the bank's share price slipped further, and analysts began revising valuation models to incorporate a regulatory risk premium. That premium reflects not just the immediate cost of halting sales, but the longer-term shadow of potential fines, restitution, and a tarnished brand. In a market that prices risk in seconds, the investigation's ripple effect is already baked into the stock's forward-looking price. For the compliance officer at the center of the storm, the personal fallout is stark. The officer's signature, once a routine tick box, has become a focal point in an internal review that will determine whether procedural lapses occurred. The internal audit team, armed with the same paper trail that once documented compliance, now scrutinizes each line for material misrepresentation. The outcome will not only affect the officer's career, but also shape the bank's narrative to regulators and investors alike. Regulators are no longer content to hand out soft warnings. SEBI's decisive action, coupled with the market's immediate reaction, illustrates a new enforcement playbook: swift, public, and financially consequential. The internal pressure on HDFC's compliance function, the mounting paper trail, and the direct hit to the bank's valuation converge into a single, dramatic tableau, one that will define the next chapter of HDFC's corporate story. As the investigation unfolds, the stock's future hinges on two variables: the depth of the audit's findings and the market's willingness to forgive. If the audit uncovers only minor procedural gaps, the regulatory penalty may be limited, allowing the share price to stabilize. Conversely, if systemic mis-selling is confirmed, the bank could face a cascade of penalties, further outflows, and a prolonged erosion of investor trust. The narrative is still being written, but the moment SEBI raised its voice, the market listened, and the echo will reverberate for months to come. The compliance scandal surrounding HDFC's mutual fund arm forces every retail investor to reassess risk exposure. First, diversification-wise, the probe narrows the safety net you may have counted on from a flagship Indian conglomerate. HDFC Bank's shares already slipped 11% after reporting profit growth that missed forecasts. Source: Reuters. That dip signals market sensitivity beyond the fund itself, meaning any heavy allocation to HDFC-linked products now carries heightened concentration risk. Second, the broader banking picture adds pressure. Loan growth slowed to 12% year-over-year in Q2, the slowest pace in 3 years, raising questions about asset quality across the group. Source: Bloomberg. When a parent's core earnings wobble, the downstream fund operations can feel the strain, especially if investors begin pulling money from associated schemes. Third, SEBI's direct action is a red flag. The regulator has opened an investigation into alleged mis-selling of offshore funds and ordered a halt on sales of several mutual fund schemes pending a detailed audit. Source: FT. Source: SEBI. While the investigation does not yet confirm wrongdoing, the forced suspension limits new inflows and could trigger redemption pressure. What this means for your portfolio diversification. If you hold a sizable position in HDFC mutual fund products, consider rebalancing toward assets that are not tied to the same corporate governance umbrella. Shifting a portion into domestic index funds, government bonds, or diversified international ETFs can cushion potential volatility from any future regulatory fallout. Final verdict: hold, sell, or monitor the compliance fallout. For investors whose exposure is modest, under 5% of total assets, maintaining the position while closely watching SEBI's audit timeline is reasonable. If your allocation exceeds that threshold, the prudent move is to trim the holding now, locking in current valuations before any possible market reaction. Those who are fully invested should monitor news releases daily. A sudden enforcement action could accelerate outflows and depress prices further. CTA: stay ahead of the curve. Subscribe now for real-time alerts on the HDFC regulatory probe and get the next-level analysis you need to protect your wealth.